everyone, welcome to the next installment of Charts and Perspective, where we use charts to dive into the world of economics and financial markets. I'm Jennifer Nash, an economic and market research analyst for Verify. Today we're going to look at an economic indicator that doesn't get as much mainstream attention, but it combines a wide range of economic data into a single powerful signal. In fact, Lance Roberts of Real Investment Advice has referred to it as the most important and overlooked economic number. That indicator is the Chicago Fed National Activity Index, or the CFNAI, which you'll hear me refer to throughout this video. The CFNAI gives investors and economists a broad view of U.S. economic activity and gauges potential inflationary pressures. It does this by compiling 85 monthly indicators across 4 key categories: production, sales, employment, and consumption. This comprehensive approach makes it a valuable forward-looking tool, giving us clues on where the economy might be headed in the near term. A zero reading means the economy is growing at its historical trend. Positive is above trend, and negative is below. So, looking at the latest numbers, in February, the CFNAI jumped to plus 0.18, a significant increase from negative. So, looking at the latest numbers, in February, the index jumped to a positive 0.18. A significant increase from negative 0.08 in January. Now let's bring up our first chart. As you can see, this historical series goes all the way back to March 1967. Notice how the raw monthly data, those individual dots, are quite noisy and volatile, so it can be hard to spot the underlying trend with all that fluctuation. That's why economists and analysts often focus on the 3-month moving average, which is shown here as the smoother line. It helps filter out the month-to-month noise and gives us a clearer picture of the economy's direction. And in February, the 3-month moving average rose to 0.15, up from 0.07 in January. This marks the second consecutive positive reading, and importantly, the highest level we've seen since April 2022. Now let's take a look at this next chart, which highlights the 0.7 and the negative 0.7 levels on the index's 3-month moving average. These levels are significant because the Chicago Fed has observed some important historical patterns around them. When the 3-month moving average stays above 0.7 for more than 2 years into an economic expansion, it's historically signaled an increasing likelihood of sustained rising inflation. Essentially, it's a red flag for potential inflation concerns. On the flip side, values above negative 0.7 have historically coincided with periods of economic expansion, meaning the economy is generally growing. Conversely, when the 3-month moving average dips below negative 0.7, it's historically been associated with economic contractions, indicating a potential slowdown or recession. So these 0.7 and negative 0.7 thresholds give us a quick way to gauge the overall health and potential direction of the economy based on historical data. All right, let's move on to this chart, which overlays the 3-month moving average with US GDP growth. This allows us to see how the index has historically tracked alongside the overall economy. And generally, as you can see, it's done a pretty good job. Positive readings align with economic expansion, and negative readings with contractions. However, things got a bit interesting over the past few years. Take a look at this section here. From November 2022 all the way through December 2024, the 3-month moving average was consistently negative. But, and this is the surprising part, the US economy continued to expand during that same time period. So what we were seeing is a pretty clear divergence between what the index was indicating and what the GDP numbers were actually showing. Now for this next chart, I've added a linear regression to the data. Think of it as Excel's way of showing us the overall trend of the index since it began in the late 1960s. The slope of the line clearly indicates a long-term downward trend in national economic activity as measured by those 85 indicators. This downward trend roughly aligns with the shift we've seen in the US economy, moving from a manufacturing-heavy, goods-producing economy to a post-industrial, service-based economy in the information age. Now earlier, I stated that the index is based on 85 economic indicators drawn from 4 broad categories of data: production and income, sales orders and inventories, personal consumption and housing, employment, unemployment, and hours. And in February, 3 of the 4 broad categories increased from January, with 2 categories making positive contributions. Now this set of charts shows each of the 4 components since 1967. Because of the highly volatile nature of the data, the charts are based on the 3-month moving averages. Notably, the latest data puts production and income at its highest level since April 2022, while consumption and housing is at its lowest level since April 2023. Additionally, employment is down slightly but still sitting at one of its highest levels over the past 2.5 years. As for sales, it remains within its recent historical range, showing relatively little change. And to close out, I've overlaid the four components to see how they've moved together over time. As you can see, there's a clear tendency for these components to rise and fall in sync, indicating how interconnected different sectors of the economy are. However, it's also important to note the differences in their volatility. Production and income tends to experience the most dramatic swings, reaching the highest highs and the lowest lows. On the other hand, consumption and housing exhibits the least volatility. And lastly, it appears employment and sales, to no surprise, are the two components that move the most in step with each other. So while the CFNAI might not grab headlines like GDP or inflation, it's clear it provides a valuable, comprehensive look at the U.S. economy's underlying health. Keep an eye on this indicator, as it can offer crucial insights into potential economic shifts. I know I will. And thank you for tuning in. For more economic and market insights, you can find my content regularly on the Advisor Perspectives website under the AP Chart section.